I'm glad you could make it to today's session. I'm sorry there's a bit of sunlight behind me, but we're certainly going to go over some of the main aspects on this webinar and on tax deductions. I'll just bring that up. I'll go to that one later. There, we're going to go through, of course, the tax strategies for the proper amount of RSP deductions for 2018, the maturity and taxation, how that's going to affect you when you do retire, the contributions you can make to a registered education savings plan, and you should organize your medical expenses now because October is the perfect time to start planning. Here, I'm going to switch over to a different screen. You can get rid of my ugly face there, and I'll be back. Okay, we're back. Here is, I already mentioned, the 4 things we're going to cover today, plus there's going to be one bonus item. We'll start right away. I know time is valuable. Here are the maximum allowable RRSP contributions for 2018. I'm sure you've seen these slips before. This is the particular federal tax rate for your 2016 return. The important thing to notice here are the amounts, line 37. You can go 45,000. Next jump is the 90,000, 140,000, and you'll jump at different tax rates from 15, 20 to 26, 29, and 33% income. Those are the levels we're going to keep referring to. Also, if you live in Saskatchewan, if you make over 44,601 up to 127,000, there you have a 2% tax rate on that. So there's 2% there, and we'll look up here. It's a 5.5% from there to there, or maybe even from 20 to 6, it's a 6 for 5.5 again. So you're looking at a 7.5% jump just if you go over the 45,000 mark, which is a lot of taxes. Now let's break this down. Maximum allowable RSP contributions for 2018. Well, that is 18% of your income, plus any unused contribution room that you got from your notice of assessment, probably in June or July for the prior year. Now, if you're making contributions through your employee or through work, you have to minus the deductions you've already made for the year, both for the employee side and the employer contributions. Let's say they match you maybe dollar for dollar up to a typical percentage point, which is 3% of your income. And I have an example of that to show you. Minus, if you've been contributing monthly into your private savings plan, into an RSP, let's say $200, $300, $400, $500, or $800 a month, that has to be reduced as well, because that all will affect the 18% of income that you're allowed. Here's Joe. Joe makes $72,000 for the year. He contributes $600 a month through his advisor into an RSP. His employer does match him dollar for dollar up to 3% of Joe's income. And this works out to $2,160 that Joe puts in over the course of the whole year, and his employer puts in the same amount, $2,160. Joe does not have a defined benefit pension. The maximum for 2018 is $2,944 if he did have that. He does not have the deferred profit sharing plan, and the maximum for that for 2018 would be $13,250 into that deferred profit sharing plan. His notice of assessment shows room of $87,500 unused in his contribution available space for the RRSPs. That's that same form you get back in June and July I had mentioned. Well, here's his calculations. Joe's income is $72,000 times 18%. His maximum for his income is $12,960. As an employee, Joe added $2,160. His employer added $2,160, and he adds to his RSPs through his advisor $7,200. So the total that Joe's putting in, the 2, and the 7, well, that adds up to $11,520. Now remember, he was allowed $12,000. He's only put in $11,500. He still has room for $1,440 plus his notice of assessment at unused room. He could add another $87,000. Total for Joe available to deposit this year is $88,940. If he wishes, he can talk to an advisor and get a loan to max out his RSPs and let the RSP additional deposit boost his retirement income. And there are about 5 different types available. After you've saved and worked hard all your life, there comes a maturity and taxation point, and that happens right at age 71. Oh, what happened here? Sooner or later, you must pay taxes on all the RSPs before this. Well, you don't pay the taxes, but before December 31st, the year that you do turn 71, you have to convert your RSP into a retirement income fund, a registered retirement income fund, life income fund, or an annuity, or any combination of the above, and start withdrawing the money. The federal government sets the minimum amount of the withdrawal. There's the chart. Okay, they changed the rules in 2015, so we'll only look at the right-hand column. For example, if Joe is 80 years old and he had $200,000, let's just do this. Okay, $200,000, and we times 6.82%, that's 0.0682 equals. He would be forced to pull out that year $13,640 as a mandatory required minimum withdrawal. And it goes up a little bit every year, as you notice. By the time you hit age 95, you must take out 20% every year of the balance of what you have left in that RRIF. And there's another example there. Here, let's use Joe. Joe has $375,000 in his RSPs. The first year, he must withdraw 5.28% because he's now 72 of the balance of $375. And the amount for him is $21,750. This is why it's very important to have your money split up into RSPs, tax-free savings account, and non-registered savings. This one mistake can reduce or eliminate your Canada Pension Plan, the Old Age Supplement, and the Guaranteed Income Supplement. If this $21,750 plus your pensions, if you get them, it could bump you into that different tax bracket we talked about earlier. If that happens, Ottawa will be getting more cash than they should. Remember, they can only force you to withdraw RRSPs and tax them. So with that amount plus any pension you may receive, you could easily jump into a new tax bracket. Well, I had said that. To find out more, talk to your financial advisor or contact us. You can get a hold of us at 1-877-888-9403. Registered education savings plans, contribution limits. This is a wonderful thing utilized with the grant for helping your grandchildren or your kids get into secondary education. I like that picture. Anyway, there's some time and effort involved in taking out a RRSP, all financial advisors say. Investing in a registered education savings plan may have started when your aspiring scholar was still in diapers and university or maybe college seemed a distant future. But when the time comes to start withdrawing money from the RRSP to pay for tuition, books, or any other costs of the post-secondary education, all advisors will tell you need to plan for that too because of taxes. Please note that an RRSP can be saved and invested up to the child's maximum age of 35. So even though they may or may not go to school because they're indecisive, you can keep it in there and have it grow tax deferred up to age 35. If it goes beyond age 35, you must return any government grants you had, which would be between $7,000 and $9,000, but you can keep all the growth and all the interest. Or, of course, you could transfer it to another child, your second child, a third child. The nice thing about most plans is you can have all your children on the same program, and it makes it a lot easier for you to administer, so you use it as it is required. Professor in Tax and Estate Planning from TD, Nicole Wing, she says sooner is better than later to meet with your advisor to start developing this plan. Depending on how the funds have been invested, there might also be some time required to convert these investments into cash. Yet do not use a GIC, I'll tell you that, because once you lock it in, you can't touch it. If your roof blows off or your tranny blows out in your car, you can't touch that money. It's not yours to get. Well, that goes with any GIC. They usually have terms of 1, 3, or 5 years. You cannot get your money back. But here, we're talking RRSPs, I'll carry on. The money in the RRSP account is controlled by the person who set up the account, not the student. To start withdrawing the cash, the student needs to provide proof of enrollment in this post-secondary program or institution. By saving for this post-secondary education using an RRSP account, parents can benefit from the matching contribution grants from Ottawa as well as other programs to help low-income families and provincial programs. Make sure you check into that. Besides the RRSP grant, there are other ones available. When the time comes now to withdraw the money, payments from the RRSP account come in two different ways. The refund of contributions and the educational assistance payments, which include investment gains as any other amount such as the grant money from the federal government, the Canada Learning Bond amounts, and the money from various provincial programs. So there's a couple different ways. Ewing says that the decision about which pot of money withdrawal comes from is made when is the cash taken out of the account. But she will suggest that taking out the investment gains and the grant money first, because you'll want to use up your educational assistance payments first, because if there's any left in the pool or your child is no longer going to school and you won't be going to school, those are going to need to be repaid back to the government, which I mentioned earlier. The maximum educational assistance payment plan or withdrawal is $5,000 in the first 13 consecutive weeks of full-time studies. Now, once your student has finished that period, there is no limit, no dollar value limit. If you need more than the $5,000 in the first 13 weeks as a part of the refund or tuition, you can get an overage amount. This is where the government may, on a case-by-case study or basis, also approve a higher EAP amount if the tuition plus related expenses for a certain program is substantially higher than average. Part-time students are limited up to $2,500 in educational allowance plan withdrawals for the 13-week period. The refund of contributions are not taxed, but the educational assistance payments are taxed as income, but in the hands of the student. Depending on the student's income and their tuition and education tax credits, they'll probably not have to pay any tax on the money. However, Ewing says that if your student is lucky enough to have a well-paying job or other income, you may need to watch how you take the money from the taxable portion in a given year, or they might face a tax bill. Also, Darcy McDonald, who's a Senior VP Retail Deposits, he's with Scotiabank, he said it's also important to have the right investment mix when it comes time to start withdrawing the money. McDonald, he has two daughters, 14 and 12, says he gets closer to starting university, he plans to adjust the investment mix in his registered educational savings plan to reduce the risk, just in case the markets take a big downward turn or move lower. And he's going to use the guaranteed investment funds. If you're fully exposed to the market and you saw half of your investments disappear overnight and you didn't have time to rebuild them in advance of having to withdraw from them, he said that's going to be painful. On the other hand, using a guaranteed investment fund may be better. These are available from a broker. Now, most of these types of guaranteed investment funds have resets available at the 75 or 100% level of the profit of your investment. This way, when the market goes up, you can lock in your profit or your growth. So every year, actually, you can lock it in once a year. So whatever your principal is 100% guaranteed, then the market goes up, you can lock it in again. So you're locking in at a profit. And if the market absolutely tanks, at least you've got your guarantee value there. Now, if you do your research correctly and adjust yearly, you should be able to receive 10% or more growth per year. For best results, I would use a broker that has access to all companies. Now, Advisor & Co. is one such corporation. The summary on RRSPs, it is to be used for their education, and budgeting is a very important side of that. On to organizing your medical expenses. October, again, is a great month to start finding or locating your receipts. There's a possibility of 134 different types of expenses available. Getting tax deduction for these only makes sense. Just ask your advisor for that list of items. Generally, expenses for any other dependents, total eligible medical expenses must first be reduced by 3% of your net income, or $2,237, whichever is less. The tax credit then is 15% of the amount remaining. Remember, so when you go over that $2,237, it's 15% of all your medical expenses. On to the bonus round. 3 reasons guaranteed investment funds should help fund baby boomers. Are you fully prepared to provide for your golden years? Have you figured out a reliable way to make your nest egg last for at least 30 years after retirement? Maybe you're wondering whether guaranteed investment funds will be a lucrative financial product to meet your future needs. Well, guaranteed investment fund investments are not only tax efficient, but they ensure that the investors receive a steady source of income as long as they live, no matter what the market goes through. There are several other factors that can explain why a guaranteed investment fund or a segregated fund sales are going strong. Now here's the 3 major ones. I'll move up to number 1. There. Number 1, baby boomers are an ideal age to invest in the guaranteed investment funds. Typically, people purchase gifts or guaranteed investment fund in their mid-50s, early 60s, and baby boomers are now in this prime age bracket. This group of aging North Americans is growing significantly in number, and it's going to continue to increase in the coming decades. This will open up, or it's going to open up new avenues for insurance companies that offer these. The hairline, the grain trends that will see a significant rise from 42.5 million North Americans to 64 million by the year 2025. And this risk-adverse group of North Americans will stick to a guaranteed investment fund because they avoid risk and they need something that will offer financial security. So even if the market breaks record heights, baby boomers' cash reserve grows. And these will continue to make the guaranteed investment funds popular as the investment option. Depending on a client's age, unique needs and savings, individuals can explore different options that will have the ability to protect them from any market downside. Okay, number 2. Guaranteed investment funds may offer financial certainty and high interest returns. Interest rates have consistently remained low in the past decade, and it's safe to assume that they won't see a dramatic rise anytime soon. The Federal Reserve is planning to boost the interest rates, but the changes will definitely not be major. Since the average fund has grown by 11.3, actually it's 11.7% for the last 40 years, continued growth will only benefit seniors that use this method to secure their retirement. Okay, number 3. Government pensions are often overlooked, and maybe they should be, but they do offer a long-term payout. Don't plan on this being around, but here's what they say. The Canada Pension Plan gives easy access to inflation-adjusted benefits where it will rise over time. This inflation protection bond that pays a COLA, or cost of living adjustment, and this benefit comes at an additional charge with an individual annuity. But it is free if you use a guaranteed investment fund. Every single year that you delay receiving your Canada pension payments from time, you're eligible to receive them. I'll start that again. Every single year that you delay receiving your CPP payments from the time you're eligible to receive them will boost your benefit. So while you wait for your payments, you can increase your retirement reserve by purchasing an individual retirement income fund that would cover your earnings while the federal pension grows. If you learn how to maximize your CPP benefits, it could pay you more every year. Now you can contact all the companies that offer these and all the agents, but that might take you 5 years, or you could contact Advisor & Co. This company has access to the top 35 companies in Canada and all of their rates. They can find you the best rates, period. You can get a free consultation, get a second opinion. This is just too important to make a mistake with. Now here's some of our affiliates that we can contact and make sure that you're getting the best rates from all of these companies, or at least compare what you have. There are a few things differ as you mature. For example, if you're in grade school and you fail to pass a grade, you can get a do-over. If you fail to pass your driver's test, well, you can get a do-over. If you can't back up a trailer straight, well, you can get a do-over. But when it comes to planning for retirement and saving money, there's no such thing as a do-over. This is explained to you by a Financial Horizons Group, Advisor & Co. Wealth Management. If you need more details, contact us. There's the number and the email and the phone number, or 2 different phone numbers there. We're here to assist you, sort it out, give you an unbiased opinion of your particular program, and maybe point you in the right direction. Are there any questions? Oh, sure. That's a Brian. I see him there in the chat box there. Let's go up that 11.3% for the last 40 years, I said, something like that. Let's see if I can find it. Oh, there it is. Interest rates. Yes. Okay, here. Well, let's just go live online. And we'll go right here. Well, there it is. I'll just refresh that. This is the Dow Jones Yearly and Industrial S&P Periodic Reinvestment Calculator online. And we'll just go down to what's 40 years. That's well, let's just take a look at 10 years. Calculate October 08 to October of 2018. If you reinvested every year, just reinvested the dividends, just let it sit there, in other words, you would have averaged 13.875% each year. But let's try the 40-year span. That would be 1978 to 18. Let's calculate that. 11.724% has been the average, if you just let it sit there and grow, for each year of the 40 years. So there's 11.72% rather than the 8.3 I had talked about. Or 11.3, sorry. It's actually 11.724%. Any other questions there? Oh, sure. How much? Well, let me read that. Yeah, okay. Here, let's just go over to this other chart. Let's say you have the $200,000 and retired today. Annual interest rate. Well, let's see what the banks can do for the absolute best interest rate in Canada. Oh, let's see. I'll just refresh that. And you live in Saskatoon. Okay, initial investment is going to be $200,000 in RRSP. The best rates, Oaken Financial, they're in Ontario. That's 3.6, 3.2, 3.5 through Libro, State Bank, Great West, BMO. There's Scotiabank. Worst one of the pile here is CIBC, 1.25. Well, let's say you did the deal, you're with Oaken, and you get 3.6% annual interest rate. But this is non-redeemable, so you won't be able to get your money out. If we switch it to a redeemable, let's see, is it redeemable? Yes. That will change all these rates. Redeemable, of course, means if you want to be able to get any money out prior to that. Well, they're 2.052%, 1.25%, and 1.15%. Looks like the CIBC and a lot of those other banks don't even offer that. So let's go back to that 3.6% because you're going to actually let the money just sit there. 3.6 from Oaken Financial. Let's put that into this chart. You're going to get 3.6%, and you're going to withdraw it annually. Let's say you need $2,000 a month or $24,000 a year. Inflation currently is at 2.14%, and currently I just presume you're 65 years old. So let's just scoot down to the chart. Payout schedule. Age 65, you pull out 23,977. There's your balance. 66 is your balance. Oh, you're broke. Age 73. Now, if you do nothing else, absolutely nothing else, but contact a broker and get a better rate on your RRSP, let's use that average again. 11 point, not the high one, not a low one, this is the average. So that would be 11.724. Let's say that's what you're getting instead of the bank rate. Well, that changes your chart. You're up to age 79 right now. So instead of running out at age 70 or 73, you've gone up to 79. So that certainly makes a difference for your retirement money. Let's see, at age 70, what would you have here? You got 72,000. At age 70 here, we've got 145,000. So I would suggest you should add something to your pot if that's you have 200,000. Let's say you got 250,000. Put some more money in there. Well, now you're up to age 90 before you technically run out of money. And that's one of the worst fears, is running out of money when you're in retirement, because your health might stop you from working. There could be many other issues, and we don't want to see that happen. But do not be stuck with this 3.6% rate, because you only get not even 10 years or 11 years before you're destitute, and we don't want that. Okay, let's go back here. Any other questions? Oh, sure, we can look up live data. Here's one actually that I have my funds in, and I would suggest. Here, I should have it saved as a shortcut. Here's one of them. And this is on Bloomberg. Let's look. If you're doing any investing, I don't care whether it's a bank or another broker, never deal with a company that's less than 3 years old, because basically if it's 3 years old or younger, it's still in diapers. So let's take a look at the 5-year rate of this one that I'm in, and let's compare it to something. Now let's pick CIBC. CIBC managed income portfolio. If you deal with CIBC, you'll probably find that one is probably the one that your money is sitting in. And let's just do a comparison. 5 years, there you go. There's what the banks earned you in interest in total, 6.27. And one of the funds I suggest is it's almost doubled in value. It's gone up 95.67% in 5 years. But there, live data, we can show that to you anytime. Call us for a consultation, and we'd be glad to help you out, at least point you in the right direction. Here, I'll just leave out my our contact information there for a bit. Oh, it's hiding. There it is. Okay, keep in mind the do-overs, because some things you can't do over again. But I want to thank you for attending. I see I got some other questions on here. We've got about 160 people on here right now, so I'll have to scroll through them. And if you leave your email address, I will address you personally and answer your questions. Thanks for listening.